But we had a guy in our group, he was a house flipper. He was flipping about 4 houses a year. The next year, he flipped 72 homes. That can happen in real estate, private equity, venture, where you can diversify away about 80% of your risk. Every single month, we paid our investors a check. Our investors were asking to give us more money. So in my very first fund, it was pretty much just me. I took it to my dad. My dad was a great mentor. He didn't want any equity or anything. I gave my brother 5% equity to help me with the legal docs. So I owned 95%, he owned 5% to just do the legal documents, but it was pretty much just me running the fund. So I was the one raising the capital. I did the pitch deck. I called the loans. We did the follow-up. We made sure the money was delivered correctly. I pretty much did all of that. And it actually did okay. And now I think I would have liked to have partners, just I think most people didn't believe in me enough to be even a partner with me. And so it was just me kind of running the show. But I then started to pull in some other people, other students that I was working with. So I said, hey, I just need help. Most of the workload was on following up with these loans. So we'd call them, hey, how we doing? How we looking? You know, the date's coming up in a couple of weeks. How are we gonna make that payback? And we'd try to work with these people a lot. And I needed really good people that were incredibly good with people. So I interviewed other classmates that I believed had really good social skills and people skills. My approach was most lenders call up and just say, money's due by Friday, or we're gonna sue you, or we're taking you to bankruptcy. And they really threaten with a whip, which is generally, I think, just how the IRS does it, how most loan people do it. We took the exact opposite approach. Hey, how can we help you? We're gonna accomplish this together. We're gonna make you hit your goals. We were actually flexible with payback dates. So we'd say, hey, we'd try to stick to a date like Friday, but we'd work with them. We'd try to find a good plan. We'd make a strategy together, and we tried to get a really good reputation of being someone that actually helped them and didn't hurt them. Most people see people that do loans or debt as a nuisance or someone that's coming after them or a tax collector. We wanted to be a business partner, a helping hand, a friend with them. And because of that, I believe we did about 215 loans over the first, let's call it 2 years, 2.5 years, something like that. I believe only 1, maybe 2 people didn't pay us back. Our payback rate was incredible. And I think it was because we had people that cared about people, and we had, I think, very good people skills. And sometimes some were delayed for sure. Some took, instead of 2 months, it took 5 months or 6 months, but almost everyone besides 2 paid us back in full with interest, with all the stuff. And they were happy as ever because we had helped them accomplish their stuff in their business. So it turned out to be a very good product, a very needed product for the market. So when asking about what partner should I have in my fund, I think of it, there's 3 distinct roles in a fund, 3 distinct circles. So the first role I like to call the expert investor. This person is incredible at options or real estate or trading or whatever. They're just a geek. They're in their basement all day on the computer. They're just a deal junkie. They love this asset class. The next role or person I would call is the fund manager. This person is really good at operations, legal, finance, compliance. They help put together and organize the entire fund. And the third kind of distinct role or person is what I would call your capital raiser or money raiser. These are people that are natural born salespeople. They're incredible they have just a vast network. Like, for example, I had a guy call me up a couple years ago. He's like, Bridger, he goes, hey, I've got these 2 billionaire friends. They love me to death. They want to invest into deals that I'm a part of. I've been working on this network for a while. He goes, I have no idea what fund, how to do a fund or what deals. I just have a really good network. Can I come join or partner with you on your fund? And I was like, you got 2 billionaires that want to invest? He's like, yeah, I got 2 billionaires. I said, saddle up, partner. Let's do this. Like, come on in, There are some people that are just natural born salespeople, but they have no idea how to invest. And vice versa, people that are really good investors, but have no idea how to talk to an investor, or they don't know how to put the fund together. So these 3 distinct roles, I think, are massive. That does not mean you need 3 distinct people. That could be 2 people that split up those 3 roles. It could be 50 people that take a sliver of each one of those roles. But in a fund, every single role needs to be covered. Again, expert investor, fund manager, and money raiser. For me on my first fund, I was pretty much doing all 3 of the roles. Today in my fund, I have a great partner named Dan Young, incredible dude. He is incredible he's the expert investor in blockchain. Like he is incredible at blockchain. I believe I'm pretty good at fund management, and both of us help raise capital together. And we're actually building our team right now to diversify more on that team as we launch. So back to the question for my first fund, what could have helped me a lot? I think all 3 of those, right? Having people that were really good at raising capital, people that were better than me investing, and maybe better at me than running funds. But at the time, It was just by necessity. I had to do all three. And that's just how we rolled. How do you know which one is your expertise on those things? Well, hopefully when I run you through those, you identify to one of those immediately. A money raiser is someone who constantly works on their network. They're always going to networking events. They're at the charity events. They're shaking hands. They have a big Rolodex of people. A fund manager, maybe like me, geeks out on funds, compliance, how things are structured, put together, legal, etc. The other one is expert investor. This person has done deals or been in the deal world for a very long time. And so hopefully you gravitate, when you hear those, you gravitate to one of them. Now, my opinion about partners is thus. It's kind of like dating. You know, most people are like, oh, I would love to go marry or date like a 9 or a 10, like super hot, like this person that's just amazing, right? A 9 or a 10. Now, in dating, you can do a lot of crazy things to try to date a 9 or a 10. Maybe if you're a 5 or a 6 like me, I'm like a 5 or a 6. If I'm trying to date a 9 or a 10, there's a lot of things, there's dating shows and funny things you can do. But the easiest way to date a 9 or a 10, the easiest, is just to also be a 9 or a 10. As simple as that. 9 and 10s date other 9 and 10s. Now, sometimes people swing out of their leagues a little bit, but generally a 9 or a 10 dates a 9 or a 10. I think the same thing is true with business partners. If you want to attract a level 9 or level 10 expert investor, well, then you probably should try to become a level 9 or a 10 fund manager or money raiser. Because people that are good at business want to work with other people that are also very good at business. So for example, my business partner, Dan Young, he was on the board of Intel for 16 years. AMD gaming advisory member for the last 4 years, done over 600 million in revenue through his partnerships and deals. I mean, an incredible entrepreneur, multiple Inc. 500 winner. And he's 50 something years old. I'm in my 20s. But maybe in my eyes, I saw him as a level 9 or 10 in his asset class. And he saw me that I've ran funds in the past, and I was very good at the fund management game. He saw me as hopefully a level 9 or 10 in my field. And I believe that's how we came together as great business partners. And so if you're thinking about running a fund, my approach I would say, pick one of those fields and try to become a level 9 or a 10 in that field. And what will happen is you will attract other good partners to you. Yeah, so what do I look for in a business partner? Now, I'm still learning this. I've been blessed by having incredible business partners. I've never really had a business partner that's screwed me over, taken advantage of me, and I've been very grateful for that. I've actually had good luck with finding business partners. Things that I've learned along the way, and maybe I'll learn some more in the future, hopefully not after bad experience. But this is actually what Dan, my partner, and he's had plenty of partnerships, he's taught me. Because number one, if a potential partner, just like back to dating, you should date your partner. Some people dive into business day one. Let's sign contracts, let's just get moving. He goes, I like to spend 6 months with this potential business partner. Let's test things out. Let's go to a roadshow event together. Let's do all the things like we're doing business together and see if we can date each other and maybe we want to get married into a business. He goes, this dating process is massive of testing one another. If we hop on a Zoom call and we say, hey, okay, here's our, we're trying to build this business. Here's our assignments. Let's meet back on Friday and let's talk through the assignments. And if I show up on Friday and I haven't done anything, oh man, I got busy. I had my daughter's birthday party and a cousin thing. And I go, okay, let's meet next Friday again. And if I haven't done it again by next Friday, you might say as a business, man, Bridger is just unreliable, right? And you go, well, maybe I shouldn't partner with that person. And I believe there's a full dating process you should do. Second thing that I've tried to do now, if business partners have a lot of dead bodies in their past, meaning every business they've had in the past or every person they've worked with, they ended up in a lawsuit or they blew up or whatever reason, I'm very weary of that person. Not to say people can't have second or third or fourth chances. I'm all for that. But if there's a pattern of, yeah, I started this business back in 2012 and I hated that partner. We ended up suing each other. He screwed me. I'm like, okay, well, I started another business in 2015 and that guy stole money from me. So I sued him and then we got this big fight and okay. And then 2018, we started a business and maybe they're not the problem. Maybe you're the problem is what I will think in the back of my brain. So if someone has a lot of dead bodies, I'm usually very weary of that person. Not to say I won't do business, but I'm weary of that person. The last thing I'll say is I generally like to look at a holistic view of a business partner. If they're an expert in their field, great. But if their physical body is absolutely terrible, or their family relationships are horrible, or their emotional state's out of whack, or spiritual state or whatever, like it points red flags to me again, just like dating. They could be the best business mind, but they're 500 pounds and they have energy problems and they're always yelling at their spouse and they're like volatile. I might be a little more weary of that person. I like to have business partners that inspire me, that are holistically incredible humans, that are excelling in multiple areas of their life. Not to say it's an end all be all, but I try to approach business partners of, man, if I'm going to spend a significant amount of my time with this person, probably more than even studies will show, more than your spouse and your kids, you will spend with your business associates. I want to be around people that have a six pack and are ripped and have great relationships and know how to manage money well and know how to, talk to like people that inspire me. I want to be around those types of people. And so those are a few things I'll look for in a business partner. And again, I've been grateful to be blessed by great business partners over the years. And so hopefully I keep that streak running. It's served me well so far. Because we're doing short-term loans, we could see the success and error rate on these loans very quickly. It didn't take some loans take 3 or 5 or 10 years to know if they're bad or good. We would know in 30 days if this loan was bad or good. And so we would track people. If they were green, they would be these are good people we would try to talk to them every week. A text, an email, a phone call, just to follow up. Hey, how are we looking on that loan? What's going on? Are we in the process? And if that person responded favorably to us, we put them in the green. You can easily tell if you have people with good people skills, you can tell if someone's a little negative or now going to ghost you and not talk to you again. So we put them in a yellow or red phase. So we would track our, at least, I guess, esoteric opinion of these deals and how well they were doing. And then after the 2 months, again, did they complete or are they in default? And if they're in default, are they communicating with us? Yes, which is good. We'll work with them. We'll figure out a plan. But if they are not communicating with us, that is bad news. If someone has passed their default rate, they won't answer a phone call, text, email. What do we do next? And so we had a whole plan that we would follow through to work with that person to try to get them back on the phone with us. So if someone, again, we would try to talk to them every week. Let's say it's 2 months, they have not communicated with us. The end date comes, we would notify them, notify. Again, they are not communicating with us. They go cold. There's only a few ways to wake someone up to communicate with you. I would send them a notice. Hey, we intend to send you to collections. And I would say, I do not want to do this. I would love to work things out with you. We can make it happen. But if you don't communicate with us, this is our only option. I have a fiduciary responsibility to my investors. We have to send you to a collections agency. And what that collections group will do is they will put a hold on your credit and will send you a lawsuit and or bankruptcy court if you're going into bankruptcy. That's the path we're on. I do not want to do this. And I'd send them a voicemail, I'd send them a text and an email. I do not want to do this. I would love to work things out with you. It's way more expensive for us to do this. It's expensive for you. We've been talking for the last 2 months. Let's work this thing out. Just let us know what's going on and we can work with you. 9 times out of 10, if someone had not communicated with us and we sent them that letter, they would call us. Hey, Bridger, okay, and I right on the phone, I'd say, hey, I'm not trying to be the bad guy. We need to get paid back somehow. So let's figure out a plan on how to make these payments back. What's been going on in your life? Oh man, I've been in the hospital. I've been in the hospital for 2 months. My wife has this thing. My husband's doing and they had some tragic things. And I said, hey, that's totally fine. Again, I have a fiduciary responsibility to investors, but I'm happy you're communicating with me. Let's work through it over the next couple months. And again, that's how we had, I think, over those 200 plus deals, only 2 people ever just no called, no showed. We had to take through collections and, do a lawsuit or whatever it was. I can't remember the whole process. But only 2 out of 200 plus, which was pretty cool. Today, looking back, if there's another benchmark I could look at for my first fund, one of our constraints was just size and volume. So again, we're doing small loans. I was in my 20s and these loans are $2,000 to $5,000. So I was very focused on doing loans and making sure they were good loans. And we managed roughly, let's call it $850,000. So a relatively small fund, and we would roll that money. So it was a couple $1 million a year we'd roll into loans every single year. If I could look back and do more, I wish I would have spent, again, I was focused on, I wanted to have very good performance for my investors. I thought, I don't care if it's 800 million or 800,000, I want to have a very, very good performance, which I think is crucial. I wish I would have maybe hired somebody else to go and get more business for us, meaning more loans. Doing, $800,000 of loans rolling at $2,000 to $5,000 per person is relatively small. I wish we would have said, because we had plenty of money. Our investors were asking to give us more money. Hey, Bridger, can I give you more money? I'm loving the returns, because every month we'd give them a check. Every single month we paid our investors a check on the returns, and they loved it. So they were asking us, hey, my friend wants to get in, we pull more money, and we were turning away investors for about 2 years because we didn't have enough loans and a team around us to do these loans. What I've learned, at least in my time running funds, and maybe I'll learn more in the future, is it's funny, you talk to one law firm and they'll tell you, oh, this is the gospel truth. This is how it's done. This is how things work. And then you talk to a different law firm and they will tell you contradictory things from the first law firm. And they'll say, no, this is the gospel truth. Those guys are idiots. They're stupid. Like, this is how you do it. And then you sit there and you go, well, what is correct? I have 2 law firms that are very reputable telling me I can do something or I can't do something, and it's actually very confusing. So I actually use a data set of different groups. So actually, we use ACA. They're one of the top groups in the world for compliance, ACA. We run all compliance questions through them. I also cross-reference that with our law firm. Hey, what do you guys think of what this opinion was? And I also cross-reference that with our third-party administrator and our auditors, which are different firms. So I've now, with our fund, we have, let's call it 4 or 5 different firms. And I cross-reference a statement or a claim of something is compliant or something is not compliant from a handful of people to get a sense of what is true and not true. And thankfully, so far, those things haven't bit me in the butt yet, but they could have. Where I've seen law firms tell me this is the gospel truth, and then I go look it up and it's not the gospel truth. And I go, hold on. And they go, well, sorry, we interpreted that wrong. And it's kind of scary sometimes. And so I use a plethora of resources now to make sure I'm compliant, I have things buttoned up, and things are done the right way. So do you need an advisory board for your fund? I think the answer is you would like one. Yes, it's great to have one. Always be building out your advisory board. In my opinion, do you need one to start? No. You do not need one to launch. I did not have one when I launched my first fund, but I've built advisory boards over time to beef up our offering and our team around us. Again, I'm in the sense of launch and get moving. People, and myself included, we wait way too long to launch things. We wait and we sit on things for a year or 5 years or 20 years. And we would have moved a lot faster if we just tried to launch and start moving. Now, if you have an advisory board, great. That'll all the better to you. But do you actually need one to launch? I would say no, in my opinion. The difference between a fund and a syndication. In my vernacular, a syndication is a deal-by-deal basis. So I'm raising money for a specific deal. Hey, we're going to go buy 123 Park Avenue, and here it is. And you can invest in the deal. A fund, in my vernacular, is we're going to buy a plethora of properties or assets in a pool or a blind pool of funds. So and when I mention syndication or fund, that's kind of what I mean. And there's pros and cons to both. Generally, I have seen syndications are a great way to build a track record. It's usually easier to raise money for. They're easier to structure. Say, hey, we're going to invest money and we're going to buy this one business. Great. And you do a couple of those. And then you say, hey, over the last couple of years, we've bought 4, 5, 6 businesses. They've done pretty well. What if we launched a private equity fund? And instead of buying one business at a time, then we're going to go buy 25 businesses in the same asset class and category. And the benefits of a fund is that you have diversification. You have multiple assets spread across for an investor, usually way more scalable. Funds, it allows you to have better interest rates with banks. It allows you to scale. It organizes your investor into one pool, and it allows you to actually close on things faster. In a syndication, hey, we found this great business to buy. Cool. Okay, we got to spend the next 90 days raising money, pulling money together. Let's go buy the business. In a fund, you've already raised the capital together, and bam, you can go close on the property. So for example, we had a guy in our group, he was a house flipper. He was flipping about 4 houses a year. So he'd find the house, he'd get together bank money, hard money, investor money, or his own money. He'd pull that together, and then he would set up an LLC. He'd go buy and flip the house, and then he'd turn around and start over. and which was fantastic. The average house flip, I think it makes roughly $55,000 per house flip. If you look it up on Google, it's about $55,000, which was awesome. He came to us and he's like, hey, I want to scale this. We said, great, let's do a fund. We set up a fund with him. He raised the money once, set up the entities once. The next year, he flipped 72 homes out of that fund, which is kind of cool. So again, from 4 funds to 72 homes in 1 year, going from a syndication to a fund. Now, I was speaking about 6 months ago on stage to about 400 real estate professionals. And I was asking them on stage, I was like, hey, so if, syndicators versus funds, if you had a fund, like let's call it $10 million in a pool ready to go, do you think you'd win more or less deals? And they're like, more. I'm like, do you think you'd have better or worse interest rates from a bank? Well, probably better, right? Banks like to lend to repeat clients, will give you better interest rates. Do you think you could close faster or slower? Probably faster. You can close faster on deals, right? I was like, do you think you'd win less or more deals on, like, at the auction? He's like, oh, we'll probably win more. So I'm like, okay, so you're going to win more deals. You're going to have lower interest rates. You're going to be faster to close. Oh, do you think your average cost per house flip will go up or down? Probably down, because it's economies of scale. You can hire the same painter to go do all of your houses, and they'll probably give you a group discount or a volume discount. Same with carpet, same with appliances. And so the idea that you can scale and you have economies of scale. And so I asked the audience, I was like, hey, how many of us have we're bidding on a home or a property or something, and somebody outbids you? And you go, wow, they're way overpaying for that property. And the whole room, everyone raises their hands like, oh yeah, we sit there and we go, oh man, they're overpaying. They don't know what they're doing. They're idiots. They're going to lose money on that deal. And maybe they are. Or maybe they're not playing the same game me and you are playing. Maybe they're getting way cheaper cost of capital. They have economies of scale. And maybe it pencils for us at $1 million, but it pencils for them at 1.2. So they can actually bid more than us on the deals. I said, additionally, right now, BlackRock, State Street, Vanguard, these mega firms are buying up residential real estate at masses. A couple years ago, it was 1 in 7 homes were purchased by Wall Street. The next year was 1 in 5. The year after that, they're getting data right now, and we'll see if they publish it, but it's about 1 in 4. About 25% of residential homes purchased in a year are purchased by big firms on Wall Street. They are paying full cash offers, overpaying for houses. I go, why? Maybe they're pooling together $100 million of single family houses. And they're going to flip it and sell it for $120 million to somebody else. And so they're happily going to go to the auction and outbid you. They're playing a different game than me and you are playing over here, just trying to flip houses one by one. That's the power of a fund versus a syndication. So these are the 3 things that I have used to create a successful business model when running a fund. The first thing I would walk someone through is a framework that I like to call risk, control, return. In any fund or any investment idea, you are trying to derive alpha. You're trying to find asymmetrical risk versus return, which we talked about earlier, which is relatively low risk for high return. And some things that you're going to look at have relatively high risk for low return. Others will have neutral risk and neutral return. Other things will have lower risk for higher return. Hopefully we can find those things. So what I like to walk through for myself and others is this: risk, control, return. The first thing is risks. I will try to label out every single risk that we can think of, and we'll put them in 2 buckets: things that you can and things that you cannot control. So for example, if we're doing a real estate fund, if we're gonna go buy big apartment complexes, what are things that we can and can't control? So, well, I can control rental rates. I can control how much I'm gonna rent my project out for. I'm gonna control what rehab costs are. I can control what the purchase price is. Okay, what are things I can't control? I can't control the next political election. I cannot control interest rates, but they're still important. I still need to have them a part of my thing. So I will list out the things I can and can't control. Secondly, I'm going to look at how sensitive I am to those risks. So you can run a sensitivity matrix, where it's a cool little matrix you can put together that shows how sensitive is my returns of a base case, best case, and worst case scenario depend on that risk. So for example, if we raise rents by 10%, how much does that change our worst case, best case, and base case scenarios? If we lower rents by 20%, how does that affect our returns of our worst case, best case, and base case? How sensitive are we to rental rates? If interest rates drop by 2%, how does that affect our returns? If they go up 2%, how does that affect our returns? If there's a war that breaks out in the Middle East, does that affect our returns? If there's a new president that comes in, how does that affect my returns? So I try to derive, again, risk, control, return matrix for my fund. And if I can minimize a lot of the risks that I can and can't control, if I can minimize those things and show myself, first off, before I show investors, I got to show myself that even in volatile times, we can still drive a pretty good scenario, that we've minimized most of our risk with a pretty good return. We can do extremely well. I was actually with Ray Dalio a few months ago, met him in person, we talked, and he actually shared with me, he said, about 80% of your risk you can diversify away in your investment portfolio by having uncorrelated investments. And again, every investment field is gonna be a little different. He's speaking specifically to hedge funds, but it can happen in real estate, private equity, venture, where you can diversify away about 80% of your risk. And so the idea was focus on things you can and can't control. Look at how sensitive you are to those things and how do they drive a worst case, base case, and best case scenario.